All right. Well, welcome everyone. I want to thank you for joining us this afternoon. Before we started our call, I was chatting with our speaker today and was saying, we can always tell what's going on. There's lots of activity or interest based off the number of people that we have registered for webinars. So we knew that today would be of high interest for many of you. So thank you for joining. As a reminder, for those of you that have participated before or might be your first time on our webinar with us, you are in a listen-only mode, but we do encourage you to ask questions. So there is a question and answer box in the bottom middle of the screen. If you already have questions, feel free to throw them in there. If questions come to mind as we're going through, go ahead and put them in as we're moving along. There will be time at the end to answer additional questions, but ideally we'd like to answer them as we're going through on slides that they might pertain to. Um, so with that, I will formally introduce myself. We do have a couple of guests on the call today. So my name is Lindsey McKay, and I'm owner and lead advisor at McKay Wealth Management. And today we're joined by a portfolio manager, from our portfolio manager that we work with, JP Morgan, Justin Sidhu. And Justin, we've had a long relationship with over many years, and really appreciate the partnership that we have with JP Morgan. So I want to thank him for joining us, and I'm going to now turn the presentation over to him.
Thank you, Lindsay, and good afternoon, everybody. Thank you for joining. There is certainly a lot to talk about each and every year, perhaps even more so as we start here in 2025 with everything that's going on, politically, with the stock market, with the economy, and we've got some slides that I'm going to share to do that, to sort of just help facilitate our conversation this afternoon. And we use these slides to help just guide us. It's called our guide to the markets, but it's sort of our GPS, if you will, when it comes to what's going on in the world, and can we take out the noise, and can we just focus on the facts and what's important. And it's about a 75-page guide. It tells us all about what's happening in the world, in the stock market, and the bond market, and we like to use it because it is factual, and it's not based upon what we're hearing on the left side or the right side, which is quite noisy, if you will, today. So when we focus on the facts and we focus on what's important, then it does help us as investors make better, more informed investment decisions. And so there's a handful of these slides. Lindsay has access to these as well. If there's any of these slides that you feel particularly, take a liking to, by all means, you can ask Lindsay for them, and she can share them with you as they are approved for you guys to see. Where I'd like to start today is actually on the U.S. economy, because the economy, even though we're investors and we kind of want to know what's going on in the stock market, each and every day or every week or every month, it's really more important to start with the economy, because if the economy is growing, then it's likely that you may see that the stock market is also growing. If the economy, on the other hand, is contracting or going backwards, then perhaps that's some warning signs or some trouble signs for the stock market. In other words, you don't get one without the other. And so if we start with the economy, the U.S. economy that is, and we just get a sense as to, well, how does the economy grow in our country, in the United States? And you'll see, this is the last few years of the U.S. economy. It has been pretty resilient economic growth. We haven't really had any quarters over the last few years, outside of one, where the economy's actually, gone backwards. And so when the economy is growing, it's expanding. If we happen to go down 2 quarters or more, then that's known as a recession. And that seems to be a word that crops up almost every year. Is the economy going to go into recession? And it's a scary word. It's a painful word. Recessions don't feel good. But I think it's encouraging for us to start on this chart, because we have, as an economy, have not been in a recession now. You'd have to go back to 2020, which were really just the first couple of quarters when the economy shut down during COVID. Really, ever since then, this economy has been very resilient. Now, if we look at the shaded colors here and kind of what makes up our economy, I just would like to just to focus on the light blue shaded area. That's consumption. You'll see this every year. The U.S. economy is about two-thirds consumption. You and I going out and spending money. And are we spending money? Do we feel good about spending money? Uh, and that's usually about two-thirds of how the economy grows. We are the backbone of the U.S. economy. The other areas are going to be business spending, which is the gray little shaded area, government spending, which oftentimes is pretty resilient. We can talk about that in a moment. But those three categories, by and large, make up how the U.S. economy grows. Now, last year, as an example, uh, about 80% of how the US economy grew was consumer spending. And so the consumer played an even more important role than usual in 2024, with the economy growing last year about almost 3%. It was a little bit better than expected. And of course, as I mentioned at the onset, when you have an economy that's growing, then it's important to note that the U.S. stock market tends to also have the ability to grow. Now, it is worth noting because we do hear this a lot, and that's, well, the consumer spending because there's higher prices and inflation's been higher. Yes, that's technically true, right? It takes a little bit more money out of our pockets today to buy the stuff perhaps that we want because inflation has been a little bit more of an issue over the last, two or 3 years. But it's also worth noting just how healthy the consumer balance sheet actually is. And that's the left-hand side of this chart. And so when we look at the consumer balance sheet, we have to look at assets and we have to look at liabilities. And when you compare the two today, the ratio is really, really strong. And so what makes up assets? It's our home values, which of course have gone up. I'm based out of Seattle. I certainly know I live up in the Ballard area. So I'm certainly well aware, as all of you are, in terms of just how strong and resilient the housing market has been. But what else makes up the consumer balance sheet? It's our assets, it's our investments, it's our pensions, it's the money that's sitting in our banking accounts, our deposits, and when we add that up today, it's about $190 trillion. In other words, household net worth in the United States is about as high as it's ever been. And so when we think about what has caused us a bit of pain over the last few years from a consumer standpoint, and we think about the cost of basic stuff when we go to the grocery store and we fill our gas tanks up, or we go on a vacation and we say, gosh, like it seems like it's a lot more expensive than it used to be. You're not wrong. But on the other hand, the consumer balance sheet at the level that it's at, when we talk about the US having the highest net worth it ever has, what it's meant is that consumers' ability to spend money, quite frankly, has never been stronger. With everything that has gone up in value and our assets appreciating in value. And we're sensitive to the fact that we have to have assets, of course, to appreciate some of these numbers that you're seeing on the left-hand side of this chart. If somebody doesn't have assets, then that sting of inflation is probably being felt a little bit wider. Now, the other thing to note is that when we look at liabilities, which of course you don't get assets without liabilities on a consumer balance sheet, when we look at liabilities, 66% of liabilities are mortgages. Now, the average mortgage rate in the United States on 80% of our mortgage debt in the United States is 3.8%. 95% of mortgages in the United States are fixed rate mortgages. So if anybody's bought a home or refinanced a home at any point really in the last about 15 years or so, has realized that that 3.8% mortgage rate is really quite low. And why that's important is because as much talk and discussion as there's been over the last few years about, well, what's the Federal Reserve going to do? Are they going to cut interest rates? Are they raising interest rates? What are they going to do next week or next month? The reality is that for most U.S. Debt holders, their liabilities, by and large, are held up in their homes, and that home is at a low interest rate that is fixed. So day to day, week to week, the U.S. consumer is not particularly sensitive to interest rates as a whole. Now, we could look at things like revolving credit card usage, or auto loans, or student loans, and say, well, those have gone up, or there's been some delinquencies. That is a small subset of the overall debt pile, of which just looking at revolving credit card usage or student loans by no means adds up anywhere near to what we have in mortgages as a U.S. consumer. And so it doesn't mean we like paying the prices that we do as a consumer, but the ability for the consumer to stay afloat over the last couple of years has a lot to do with the fact that assets have also gone up in value so much that they've more than offset the inflation number that has been high, or interest rates that have been higher than normal, which has all led to the fact that as we shift to the U.S. stock market, which is this is the S&P 500 on this chart that goes back to 1996. All of this has led up to the fact that this U.S. stock market has been able to stay afloat and has been very resilient over the last 30 years, specifically the last 10 or 15. We've had some bumps in the road, as we've talked about. We've had 2020, which was COVID. It was a very short-lived market correction, but it came back in a roaring way. We also had 2022, which was a little bit more of a prolonged market pullback. But we have now eclipsed those market highs of 2020 and 2022. And as you can see, just as of late last week, the S&P 500, I was talking with Lindsey about this just before our call. The U.S. stock market was able to achieve 57 all-time new highs in 2024. 57 all-time new highs on the S&P 500. We actually had another all-time new high last week, which put the S&P 500 firmly above 6,000. It doesn't mean to say that we have all of our money in just one area of the stock market. We're going to talk about that in just a moment. But when we take a look at just a snapshot of how the U.S. economy has been able to grow, and therefore how the U.S. stock market has been able to keep afloat, it has been nothing short of extraordinary, certainly relative to the rest of the world. Now, I mentioned this, and I think that this is certainly an important chart for us to, look at and just take note of here, just for a moment. In the last year or two, certain companies, which you'll actually see down in the footnotes here on the bottom of this chart, some of your tech-driven companies specifically, the way that the stock market works, the makeup of the stock market, is that when a company gets bigger in size, it comprises a bigger percentage of that stock market. So the bigger the companies that we have in the stock market are also responsible for taking up a bigger share of the overall pie. And that has specifically been more tech oriented over the course of the last handful of years. And as you can see up in the top right of this chart, when we look at the makeup of the top 10 stocks in the S&P 500, remember there's 500 stocks in this index. When we take a look at the percentage of the top 10 stocks as of last Friday, they made up almost 40% of this index as a whole. In other words, there is a greater degree of concentration in the U.S. stock market today than perhaps there ever has been. If we look up in the top right again, we can even go back to the technology bubble, what was referred to as the tech bubble, leading up to 2000, where you could see that those top 10 stocks as a percentage of the index got up to about 27 or 28%. And then the tech bubble burst in 2000, and the market had a pretty significant correction. It's not to say that that is our base case today by any means, but what it does mean to say is that when stocks become increasingly concentrated in an index, then that index perhaps is not as diversified as we would like it to be. Again, considering there are 500 companies in this index representing a multiple amounts of sectors. We've focused strictly on tech as investors quite a bit over the last couple of years. But we have to remember that there are other sectors like financials and industrials and healthcare stocks, utility stocks, among others, that make up this index. And so there are opportunities, we think, as investors to continue to rebalance portfolios and find some other sectors that therefore make portfolios a little less concentrated as the US stock market is as a whole today. The other thing that I would make point of, and we can see this over in the top left, I won't spend a lot of time on valuation, but it is important. When a stock continues to go up in value, usually that means that that stock market or that specific stock or sector is also becoming a little bit more expensive. What has done well lately also tends to be an area that perhaps is at a bit of a premium, and investors are having to buy those stocks at a bit of a premium. In other words, stocks that have gone up are also becoming a little bit more expensive. And so, as a consumer, granted, I'm not this way because if I think back to just last month, when does someone do their shopping around Christmas? We tend to find a lot of consumers buying on days like Black Friday or Cyber Monday or on that weekend, just given the fact that there are deals. Why do people go out and buy stuff on those days? Because it's cheaper. I tend to buy, because I'm a procrastinator, on December 23rd or 24th. And that's a mistake of mine because I know that I'm buying when stuff is expensive, right? So as investors, when we look at something like what are the more expensive areas of the market or what are the more concentrated areas of the market, what are perhaps some opportunities as investors to find some other areas that are perhaps just a little bit cheaper. Now, one of the other reasons why we just have not seen the degree of any meaningful pullback is because we haven't had a lot of volatility. We've had some volatility to start 2025, and we can talk a little bit about that here in just a moment. But when we look at this chart, which is oftentimes one of the most used pages in our guide to the markets, it helps explain to us as investors, what does typical volatility look like? And this is a chart that actually goes back to 1980. And it's a snapshot of the S&P 500 again. And the little reddish purplish dots that you see on this chart, that actually reflects what the largest pullback or correction was in the stock market for that year. So some years you'll have, like we did last year, we had only an 8% pullback last year, all of last year. And the year prior to that, in 2023, we had a 10% pullback. So far this year, we've had about a 2% pullback. But the average over time, if we were to take all of these little red dots and we were to average them out going back to 1980, then the average pullback for the US stock market is actually closer to 14%. Okay. That's the price, in other words, that we pay as investors for the risk that we take being invested in stocks. It's not a linear ride upwards. There's always going to kind of be something that gets in the way at some point in time that kind of derails the conversation for a moment or a week or a month, perhaps. But the important number to take note of is that despite that pullback of about 14% per year, you can see by the gray bars, which I'll explain in just a moment, how resilient the market is in getting back to being positive. And so the gray bars actually reflect, well, what happened as of December 31st? What was our year-end number for that specific year? And if we add up all the gray bars over the last 40 or so years, then despite that pullback of 14%, we've experienced positive returns 34 out of the last 45 years. In other words, if you were a baseball player, that's a 750 batting average. Okay. The market has an ability or has shown an ability over its history to be positive 3 out of every 4 years. carrying a batting average of 750, it would be the best baseball player in the history of Major League Baseball by a margin of 2-1. That is the resiliency of the U.S. stock market. Now, 2025, as we've already perhaps seen in the first few weeks of 2025, when we don't have a lot of volatility in the preceding years, and there's a change in administration, and stocks, as we just talked about on the previous page, are a little concentrated. We've got some really, really big companies out there that have done really, really well. Then we could perhaps see that volatility comes back, which is why we use this chart to say volatility is normal. It doesn't feel good. It can be painful at times, but think about the resiliency. Think about that 750 batting average. As an investor, when we think about any kind of discernible pullback in the equity markets of any kind, a 5%, a 10%, a 20%, whatever it may be, all that means is that stocks just got cheaper. And so investors have a decision to make at that time about how they want to play stock market volatility, and perhaps if they want to monetize that volatility in a way by making shifts in their portfolio. And you can certainly talk to Lindsey about what that could potentially mean. Now, I want to shift just for a moment about some topics here in 2025 that are certainly in the wheelhouse again of discussion. One being inflation. And I kind of touched on this perhaps just for a quick second earlier. This is a snapshot of inflation for about the last 6 years or so. And if we think about the years preceding 2022, and really for about 10 or so years prior to 2022, inflation was really never that big of a deal. As you can see off to the left-hand side of this chart, up until we get to about 2021 or 2022, inflation was hanging in there about 2%. When inflation's about 2%, the Federal Reserve doesn't really have to do a whole lot. In fact, Janet Yellen's entire reign as Treasury Secretary, I don't think she ever had to raise interest rates one time. And so we sort of got used to living in an environment where inflation was pretty tepid. Not too high, not too low. It was really about that 2%. And that's okay. Now, I'll touch on this in just a moment, but in Donald Trump's first presidency, when he came into office in 2016, when you go about implementing certain policy in an environment where interest rates are low and inflation is in check, you can get a lot more done without worrying the markets. Now, we'll touch on that. We'll come back to that. In 2022, we saw the highest inflation the United States had seen in 40 years. And you can see the middle point of this chart where inflation got up to about 9%. That's a problem, right? Because think about what we started with. We are a consumer-driven economy. We might be able to withstand 3-4% inflation, but sustainably having to deal with 9% inflation, 8% inflation, that does become a problem. And so what did the Federal Reserve happen to do in 2022? It took those interest rates from about 0% upwards to about 5%. That is their way of combating inflation, is by making things more expensive. Trying to rein things in when things are expensive. And so the Federal Reserve's target is about 2% on inflation. And we've come as an economy off the boil at 9%, down to about 3% as of the end of December. Now, enter the conversation around things like tariffs. Tariffs, to the extent of what we know at this point, it's a little bit too soon to tell in terms of what types of tariffs and who those tariffs may be implemented on. But a tariff is like a tax of a kind, right? It's if we lay a 25% tariff on China, for example, and we import some things from China, which we import a lot from China, that is paid by the company that is importing those goods. In turn, the company oftentimes just transfers that higher cost onto you and I, the consumer. So there has been a lot of discussion around the fact that tariffs could make an inflationary environment perhaps restart again. An inflationary environment that had come off of the boil, and the Federal Reserve was getting very comfortable around what that inflation number looked like, and the market was feeling comfortable around that. And in fact, could that start to reignite again? That's been a little bit of the angst that we've had to see in the marketplace to start 2025, not knowing what these tariff numbers look like, or is this a negotiating tactic to get other companies or other countries to sort of get in line with a little bit more of a U.S. Exceptionalism type of policy. So more to come on the tariffs. It's a little bit too soon to tell. The only other aspect to the inflation question comes around the restriction of immigration, which has been in the headlines more over the last couple of weeks as well. Certainly, one component of inflation is wages and wage growth. And when wages are increasing, what does that do to the overall inflation number that the Federal Reserve is trying to just keep in track or keep on track? Having to replace certain jobs at potentially higher wages is also something that certainly economists and the market are looking at right now. So those two policy items, a little too soon to tell, but they are applicable to the overall inflation question. Now, from an investor point of view, there is the thought or the mindset that those topics or those policy on the agenda could be counteracted or offset by lower taxes on corporations, as well as a less or deregulatory type of environment on businesses, which has been in many business leaders' eyes over the last few years, a little bit just more red tape to have to get through to get stuff done. So you see some businesses or some sectors of the market cheering certain potentially pro-growth policy agenda items while having to offset and balance some of the inflationary measures that could also be coming down the pipe. So a little bit too soon to tell on that. Inflation is heading in the right direction, and it is still continues to be our base case at JP Morgan that inflation does in fact still align where we want it to be by the end of the year. But all of this, at least at the onset, has meant that interest rates, which have been a really hot topic for the last, 3 years, and when is the Fed going to cut interest rates, and what's that going to mean for the market? All of that, sort of a day-to-day, week-to-week sort of questions that we're having to answer. Everything that we just talked about. A strong economy and a consumer that's spending money and a market that's doing well, and the potential for inflation to perhaps start to maybe trend a little bit higher. All of that has meant that interest rates are probably coming in at a lower pace or not as high or quick a pace as that many investors thought would be the case last year. And that's what you actually see here on this chart. So you can obviously see back in 2022, this big upward trajectory of interest rates as the Federal Reserve was trying to counteract inflation at that time, got all the way up to almost 5.5%. And then late last year, the Federal Reserve started to gradually cut interest rates. But they're not in any rush, we don't think, to cut rates at a quick pace from here, because their job is to ensure that everything more or less kind of stays in some semblance of balance. And they don't like things to get too frothy, but at the same time, they also want to make sure the economy's growing. And so it's a delicate balance that the Federal Reserve is always trying to get right, which is a difficult job for sure. But as you can see off to the right-hand side of this chart, the market, so there's two sort of sets of lines that you see here. The blue line is actually where the Federal Reserve thinks that short-term interest rates are going to be over the course of about the next 3 years or so. Now, remember, what we got on our CDs or money markets, by and large, over the last 15 or 20 years, was pretty um, meager at best. Oftentimes, when we went to the bank and we said, "Well, what's your savings account paying?" or "What's my money market rate?" It was probably lower than 1% on average over the last 15 or so years. We were getting upwards of 5 plus over the course of the last couple of years as the Federal Reserve did raise interest rates. Now, we're not getting as savers on our deposits or on our money markets as much. That's what happens when the Federal Reserve starts to cut interest rates. But as you can see here, moving forward, we're not going back down to 0% again. The Federal Reserve does not want interest rates to be at zero. But they don't want them to be at 5 or 6% higher. Like they need to strike a balance in terms of where interest rates ought to be while still keeping the economy growing, while still keeping inflation in check, and while, quite frankly, still keeping people with a job and keeping that unemployment rate quite low. The challenge that the Federal Reserve has right now is that the unemployment rate is low and that the economy is doing perhaps a little better than expected. And as again, inflation is coming in, but again, not at a super quick pace that the Fed perhaps would like. And all of this means that this numbers, these 3%, 4%, is subject to change based upon what the data looks like over the course of the next year. And it's going to be something that we hear as investors. Again, that question, what's the Fed going to do? What's the Fed thinking about this is going to continue to be a question that we will face throughout the course of 2025 into 2026. Bottom line, rates aren't going back down to zero again. And I think that's important, certainly from a depositor's point of view. So in just wrapping up here, Lindsey, and I'll turn this back over to you and certainly open it up for any questions. Sometimes, as investors, the market tends to have the ability to rebalance our portfolios for us or without our permission. And so, if I was an investor and I decided to put money into the market in 2019, off to the left-hand side of this chart, and we hear an allocation of 60-40, which means 60% stocks and 40% bonds. That's what you're going to see off to the left-hand side of this chart. You've got 40% bonds and you've got the stock allocation that's made up of growth stocks and value stocks and perhaps a little bit of international as well. Now, let's say that we just turned everything off. We went on an island for 5 years. We just recently came back last week. And if we go all the way off to the far right, what does that allocation look like today? Meaning that we didn't rebalance this original allocation. We didn't make any tweaks to it along the way. What does that allocation look like today? What has the market done to my allocation now that I've returned from my long hiatus of looking at my portfolio? And as you can see, it actually looks quite a bit different. It's no longer a 60-40 portfolio. It's actually now closer to about a 75-25 type of portfolio. Growth stocks make up, again, not surprisingly, that's where all the tech is, more of this allocation. International is just a touch less, and bonds are certainly a lot less in this overall mix. And what's interesting about this is that the stuff that tends to constitute more of a portfolio over time also potentially is some of the stuff that's more expensive. And some of the stuff that doesn't constitute as much, perhaps is some of the asset classes and sectors that are a little bit cheaper. And so as we wrap up here, a big part of the conversation that we've had at JP Morgan for the last year or two is just ensuring that portfolios are in balance or getting back to some semblance of balance. It doesn't mean to say that it has to look perfect all the time. It doesn't mean to say that we have to rebalance portfolios, every month. But it does mean to say that this market, the way that it operates, does tend to do some things without our permission, and it's important as investors to be proactive and have our eye on the ball, as I'm sure you do working with Lindsey. So, Lindsey, I will stop there, and I'll stop the share. And I just want to say thank you for having me, but I'm certainly able to take some questions if there are any.
Yeah, thank you, Justin. Really appreciate everything that you shared. There are a few questions. Maybe we'll start on just that last slide that we finished on. International is something that we've been hearing, a lot of companies being underweight on for a while. So would you mind talking real briefly just about that, 10% international allocation?
Yeah, so that 10% is admittedly probably on the lower end of what we see. I'm certainly not the one that created that chart, Lindsey, but nonetheless, international is a part of our portfolios. And it's international because, about two-thirds of the market caps around the world is non-US. And so we have international because of the diversification aspect. We want to just not own just US companies all the time. It has been a little bit more of a challenging backdrop over the last few years because of just how strong US tech has been specifically. When we look at international, they don't have, when we think about Europe as an example, or Japan as an example, they don't have the same technology exposure that the US stock market does. So we think about these magnificent seven types of companies, as they call them, the big tech winners of the last few years. Europe has been having to play catch up because they don't have those in a portfolio. Now, on a day like today, when tech gets hurt really badly, we're probably happy we have some other asset classes in our portfolio to offset just that tech risk that we have, that concentration risk. So um, I would say that we're pretty neutral on international as an asset class, Lindsey. We're not underweight international. We're not backing up the truck either, but we do recognize its importance from a diversification point of view uh, relative to what we have in the US.
Great. And on that diversification note, one of the questions that came in was around non-correlated assets. And so I think especially when we look at a year like last year, where sort of it felt like everything was moving together. And then we go back to 2022, everything was moving down together. There's a little bit more, I think, interest in saying, should I be having assets that are not correlated with broader market movements? Do you have any comments around that?
We would always advocate for some degree of making sure that diversification means that not everything goes up and down together. And you brought up a really good point, Lindsey. It has been tough and challenging as an investor the last few years to not be correlated. You know, bonds even correlated with stocks for points over the last 2 or 3 years. But commodities, interestingly enough, you mentioned 2022. Commodities were actually the best performing asset class in 2022. So we do recognize the importance of having uncorrelated asset classes in a portfolio. Um, to the extent that we would say those need to be a really big piece of that portfolio, we would probably advocate against because some of those uncorrelated asset classes also tend to be a little less liquid. They're a little bit harder to get out of at times, or there's just not as much information on the asset class as we perhaps have on the more traditional types of bigger asset classes. But from an uncorrelated point of view, we're always an advocate of that.
I think that's something that I've noticed over the past couple of years of just, we talked about, bank money and just there's sort of been more people having money in the bank because we're now finally getting some interest as opposed to all those years that you weren't. And so thinking about just the other assets that we have in our daily lives, our house, bank money, those things, like those are actually non-correlated assets that provide us diversification against the broader market. And so just kind of remind people to think about those in the broader picture as well.
That's a really good point. It's not. I mean, we always have emphasize the don't put all your eggs in one basket type of story. And I think in the last couple of years, there tends to be, there's the term FOMO, fear of missing out, which is fairly applicable to investors that have wanted to buy some of the higher performing growth stocks in the market. And it's okay to have some of those, right? But we need to be as investors very mindful in terms of what percentage that makes up of our overall, net worth.
Yeah, and one of the things that I think is challenging too when we think about some of those safer assets like money in the bank or CDs. You mentioned we're getting more interest than we historically have. It's not going to continue to be where it was. And I think that then a lot of people start to worry about this inflation factor and say, is there something else that I should be looking to help combat inflation outside of, the stock market? And so gold kind of always comes up in that
Mm.
conversation when we're talking about inflation. Do you have any comments around gold specifically?
Yeah, yeah. Well, precious metals have had a nice little run up. I think, part of the conversation around rotating out of some of the winners of the areas that have done well. That money has to go somewhere, right? Like when I sell something, I have to decide where I want to put that. Now, inflation over the last 2 or 3 years has been such a problem that you do tend to find investors wanting to have a piece of precious metals, whether it's in an ETF or a fund, or if it's like the actual hard asset itself via the gold. Over time, it's been an okay inflation hedge, uh, to the extent that you could have made money as an investor elsewhere. As a better hedge is likelier the case, historically speaking. Um, but again, gold is one of those things where if you're scared of the world and what's happening, and you just want to tangibly have a piece of something that's uncorrelated to everything else, if something really bad happens, then gold is an okay place, in our view, to sort of express that view. Again, we would own something that's more of a hard asset like that in moderation, only because of the fact that gold, like crypto and some others, is goes up only by virtue of what someone is willing to pay for it. And so we can't put a valuation number on gold. We can't put a valuation number on Bitcoin or crypto, right? Whereas we can put a valuation number on the stocks that we're owning or the bonds that we're owning in a portfolio. So having a bit around sort of the periphery of a portfolio, maybe not the core, we're very much okay with that. We just don't want it to be the core as much.
You touched on something interesting there, this sort of like the fear factor that's out there. And I think there's been a lot of sentiment when we think about just the what is to come. And part of that is when you think back over the past 5 years, like there's been a lot of major events that have happened. If we go back to the pandemic, if we go back, to inflation and these, quick rising rates, administrative changes, there's just been a lot that's occurred, and we keep coming back to the consumer strength as what's carrying the economy through. And
Yep.
so as investors, we're sort of waiting for when is there going to be a point where the consumer is no longer able to carry the economy. So I know that was one of the slides that you started with
Yeah.
earlier. Could
Yep.
you just talk about some of the things that maybe are tracked or monitored to say, for that sort of nervousness that we have of like how much longer can we kind of lift up through these challenging periods, to say, why the consumer is so much stronger than previously and what would really need to occur in order to be circumstances that it would become more of a concern about the, consumer being able to stimulate the economy.
Well, for one, I mentioned inflation. If you had inflation that was 9, 10%, 8%, and it was not coming down, then the consumer only can stand so much, right? Like you can't expect the consumer to be able to pay for things if inflation sustainably was at a much higher level than what it is. Um, and I'm not talking like again, I go to the grocery store, we all do. The price of eggs, like for example, is like, among other things, it gets like people angry. We get that. Uh, but imagine if everything was like eggs today. Like that would obviously cause the consumer to slow down. And when the consumer was not able to pay for stuff in the way that they would like, then that would eventually impact the economy. Unemployment We've had 48 straight months of job growth in the United States. It matches an all-time high in terms of job growth. So the fact that the unemployment rate has stayed so steady over the last couple of years, even in the face of a market correction in 2022, inflation and interest rates going up, the fact that employers have not felt any sort of impetus to lay people off in a big way of any kind means that when people have a job, they feel like they can spend money. And that would have to be something we would have to see as unemployment go up in order for us to see consumer spending come down. Uh, Obviously, the psychology of the stock market also has an impact on the consumer as well. And so if we were to see a significant pullback of the stock market for some reason, and I'm not talking like a run of the mill, just like 10%, but something happens globally, a black swan event, as they say, that were to cause some real angst and worry globally, then I suppose that could also bring the consumer in line. But I don't know, about your household, Lindsey, but we and consumers alike, we tend to spend money when we're happy, when we're angry, when we're sad. And so the consumer in the US, as Warren Buffett oftentimes says, like never bet against the US economy. It's a bad thing to do. It's oftentimes a losing bet. But those are a couple of the things that we think we would need to see happen in order for the consumer to just say, hey, enough's enough. I've got to hunker down.
And then I think that kind of wrap up the last few questions seem to be around, possible policy changes. And I heard you say earlier, just it's too early for us to tell. It'd be speculation, and we don't want to spend a lot of time going down this rabbit hole of what ifs. But as in that same vein, we talked previously about there might be some offsetting aspects of where
Yeah.
we could see some higher costs from tariffs, but we could see some, relief on the tax side. Do you maybe want to just finish on kind of a comment that kind of closes out the too early to tell, but it's not all negative?
It's not. It's not all negative. I think that if you're a business leader today, if you're a CEO of a company, then you're looking at some of the positive angles that could come via continued lower taxes or even lower taxes. Some of that's perhaps contingent on where your goods are made, and I think it's important to note that this is now a very U.S. centric type of policy and administration, right? And so it's very much get in line, sort of like if you're a CEO of the US or if you're a country outside the US, it's like these are going to kind of be the terms that we are going to be having to abide by. And so lower taxes are certainly an important catalyst for the US stock market continuing to potentially grow. And as I mentioned, there's been a significant degree of sort of bureaucracy or red tape that was input over the last few years, and a lot of CEOs took that as just like it's harder to do business in this type of environment. Interestingly enough, the most red tape and bureaucracy that you'll see anywhere in the world is in Europe. So trying to get something done over there is really, really, really hard in a timely fashion. You saw remnants a little bit of that over the course of the last few years. The market continued to still do well, but as we talked about, it was a pretty concentrated market. Where there's a positive around this, Lindsey, to your question, is that sectors like financials or healthcare, they tend to be sectors that do quite well in a less regulatory type of environments. These are sectors that haven't done as well as tech. They're sectors that we could think about from that rebalancing point of view, among others, bear in mind, that could say, hey, look, if we're dealing with less regulation, if we're dealing with an ability to get things done at a bit of a quicker pace, then these are some areas of the market above and beyond tech that could actually benefit from that. So yeah, there's certainly some things we're keeping an eye on, but I also think that like optimism, at least from like a corporate point of view, tends to therefore an investment point of view does tend to be offsetting to perhaps a couple of those negatives that we talked about.
Great, Justin. Well, more to come as always. I think, before we started the call, that's what Justin and I were talking about it, that there just seems to be more and more to be talking about quarter over quarter. And, the stock market did well last year. So we obviously wanted to review some of that and then really say that there is still some, good indicators for, positive returns this year, but, probably a lot more volatility than what we've been experiencing for the past couple of years. And so as policies change or as circumstances change, we'll see that, reflected in the market. But by the time that we talk again next quarter, I'm sure there'll be, new topics that we're hitting on that are maybe even different from today's conversation. But really just want to appreciate, the time that you shared. And as you mentioned, they do have a tremendous amount of resources at JP Morgan and put out this guide to the market that has honestly more information than anyone probably would want unless you're, truly an analyst as far as the some of the technical data. But there are some areas where we can pick and choose as far as what's maybe applicable to some of the questions that you might have. So happy to chat with any of you that would like to see more of this type of information. And with that, I will thank you all for joining, and special thanks to you, Justin, for your time and sharing your thoughts.
Thanks, Lindsey. Thanks for having me.
All right, take care, everyone. Bye-bye.